let's talk a little bit about your strategy. We already alluded to, again, for anyone that's followed you, the trade small, trade often. Let's talk about your risk management, because again, everything really seems to come down to risk management. And all of the best traders that I've ever studied, it's risk management.
Yep.
Number one, being able to survive, the longevity thing, being able to survive and do it for a long time. And it always feels like if you're able to keep your losses small, then you don't get hurt. And when you do have those wins, they can matter for you. So what is your approach to risk management?
My approach is very different than everybody else, and I I feel like this is the only approach that works. I mean, over time. A, you have to be very careful about adding to losers. People get very stubborn, and the and I've watched a lot of people lose all their money from the trading floor all the way through retail, and I've watched a lot of people survive for a really long time. And the way I like to say this is when genius fails, when you blow up, it's always because of the size. It's always because you trade too big. Either you threw good money after bad, you made a bad trade, and then you double down, or you just get too big. And that's how everybody fails. The key to risk management is not stop orders. The key to risk management is not taking losses. That is the biggest misconception. It has nothing to do with taking losses because losses are random. Some come back and become winners, some make losses even worse, but that's completely random decision and it's totally subjective. The key to risk management is staying small. That is the only way you can defend yourself. If you stay small, you can defend yourself under any circumstance. And that is the key, the ultimate key to risk management. Stay small, don't add to your losing positions. And then you'll be around forever.
Well, at a certain point, though, you have to have a strategy. It seems to me at least, it's not enough to say stay small, because you have to have a strategy that at least moves the needle for you, something that puts some type of gives you some type of edge, some type of odds in your favor. Otherwise, if you stay small and you're never, it's still a 50-50 thing. Well, what does it matter?
Well, it's
So how do
50-50
you?
if you're trading just stocks, but you can when I say you stay small,
Mhm.
that doesn't mean you can't be 50, 60, 70, or 80% invested. That just means each investment is relatively small and hopefully has somewhat non-correlated. So you don't go down, you know, if something ugly happens on either side, you're not all your eggs aren't in one basket. That's all it means. It doesn't mean to use 5 or 10% of your money. What it means is that you allocate capital appropriate to opportunity. And there's a relationship there. Whether we use volatility, but you can use anything you want. You can use price, you can do whatever. We happen to use volatility, but and higher volatility meaning more opportunity, lower volatility meaning less opportunity. But either way, each individual trade should be less than a certain percent of your capital. Like you should not be 80% in one underlying.
Right. And so what is kind of your rule of thumb there? And I'm sure it depends on the trade, but as you said, most people think of, okay, your portfolio risk, or
Yeah.
what is my position size going to be here? So what's a normal position size
It
for
it
you?
depends a little bit on account size because that does come into play, but for
Hmm.
an average size account, and again, that could be anywhere from, 30, 40, 50, 60, 70,000, which is the average size, retail account. Um, you wanna be careful that you don't exceed 10%. I mean, there's certain cases where you can make the argument to get to 15% of your net lick, not of your
Hmm.
buying power, but of your net lick. Um,
Net
and
liquidity, right?
yeah, yeah, you
Hmm.
just your actual the
Just
actual
translating your terms.
yeah, yeah, net liquidity is just the
Yeah.
amount of money at theoretical value that's in your account.
Right.
And so, if you have $50,000, you wanna limit kind of max to a single trade at maybe 7,500. It should be more around 5,000 max if you're buying stock. If you're trading options, it's obviously gonna be less than that. But the key to all this is just, I don't care how much of your capital you use. I just care that you not all committed to one single underlying. That's all.
So this is another thing that's kind of important about what you do is while you do a lot of trades, you kind of limit yourself to you're not trading every underlying. There's you kind of know your underlyings and you're just kind of structuring
Yeah,
different trades for kind of the same underlying sometimes, right?
100%, because we're pretty indifferent to underlying. So in other words, I'm about 70%. I trade about 70% listed options and about 15% futures and 15% listed futures options. That's pretty much the breakdown. I have some crypto and some stock, but I'm kind of mostly all derivatives. Um, but I don't care what the underlying is. So the strategy that I'm going to use if I'm trading the Japanese yen and the euro, um, soybeans or natural gas is the same strategy I'm going to use if I'm trading Amazon, Coinbase, Palantir, or Roku. It doesn't the models that we build and everybody else builds for the underlying derivatives, it doesn't matter what the product is. They're all the same models.
Yeah, that makes sense. So, how do you choose, I guess, how do you choose what to go after?
Well, it depends what kind of trader you are. So I'm a contrarian. So for me, it's easy. I just do the opposite of what everybody else is doing. And sometimes that works really well. On days like today, it doesn't work very well at all.
Uh-huh.
Um, because we just have every day has been Groundhog Day recently. But
Yeah.
I'm not a trend trader. I'm the opposite.
Hmm.
And that goes back to my floor trading days when we just took the other side of, like I'm the kind of person who if you want to make a bet, I'll take the other side. No matter what you want to do. I'm just assuming that you're going to be wrong. It doesn't mean you are. It's just that's just how my mind works.
Yeah. No, 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 absolutely. So, let's also kind of talk a little bit about, you know, your models,
Sure.
because you have done so many models, and again, this was one of the great things about your content was that you would share like, hey, this is what our models say, this is what our statistics say. So how did you kind of attack those studies? You've done so many studies on the market. How would you attack those? I mean, would you
It's
say we need a sample size of this much, or what? How would you do that?
well, we've been building our own database for research. I mean, we built a think tank is essentially what it is. We built uh, a think tank, a network that was kind of attached to a broker. And on the think tank, um, we hired a lot of people that are a lot smarter than we are, than the on-air talent is. We hired data scientists, physicists, mathematicians. Um, I I am not I am not too proud to say, I'm not too egotistical to say that we have a team where everybody in that team has uh, the depth of what they understand is it's just off the charts, and they're crazy smart. And what we've done is we've challenged them with, listen, I'm not putting any limits on you. You want to get deep into the weeds on some, advanced calculus thing to show how modeling's done. If you want to do something, all I won't let you do is tell us what you think, because I'm not interested in what you think is going to happen. I'm
Mhm.
only interested in you presenting the numbers based on all the research that we've done and based on all the data that we have. So, what I want to do for individuals is optimize their decision making. I want to do two things. I want to speed up their decision making and I want to optimize it. And that's what no media network has ever done before. I don't care what somebody thinks about some underlying. I only care you give me the optimal amount of days in a decay curve that I should be putting a position on. You give me the optimal delta and strikes that I should do. You give me the optimal strategies for something, and then you give me the data to support all that. And that's what I want to see. I will add the numbers together. I'll do the 1 + 1 = 2, or 1 + 1 = 3 or 4, whatever it is. And I want you to give me mechanics that let me optimize my trading so I have the best chance of success. And that's it. That's all we can do.
Right. Um, one of the elements that I just want to get back to, because I want to put a pin in the models for a moment, but I want
Sure.
to get back to something before we get back to the models is the correlation part. And one of the things that is probably very difficult in this market is with AI being such a huge subject,
Sure.
and there's so many things that are kind of like, oh, this is going to happen because of AI. It's affecting utilities, it's affecting nuclear energy, it's affecting HVAC systems, all of this kind of AI adjacent stuff. And we saw that with DeepSeek on January 27th of
Yep.
this year, where all of these, what you would have normally thought of as uncorrelated groups, came down together. Um, and you've really stressed how important it is to make sure you're not getting overly correlated. How do you do that in a market like this where it feels like the correlations are going more and more towards one?
Yeah, I mean, part of it is just an understanding of how correlations work. In bull markets like we're in now, correlations are very scattered. Like, even in the tech world, one tech stock like today, for example, Reddit's down, and one of some stock that's highly correlated to it, like Palantir or something, might be up. So the correlations in an up market are a little bit strange. In a down market, they all go to one. In a down market, everything collapses to one. So correlation is easier to talk about than it actually is to implement. And the way good traders do that, especially in the retail world today, is you are not scared of trading all products. Like, I mean, there is no correlation between bonds and stocks anymore. There's no correlation, between gold and Bitcoin, for example. There's no correlation between crude oil and natural gas anymore. So and there's no correlation, just to go down that line, there's no correlation between 10-year notes and tech stocks. And so there are plenty of non-correlated plays out there, but to put it all together is not something that's very easy. And there's no platform that currently shows you your overall, the correlation of all your underlyings. I mean, we teach it, but it's hard to program in. Like, we do beta weighting and we do some really cool stuff on a portfolio level, but the correlation on a portfolio level it's a little bit of a challenge.